All right. I think we can start. I think we're going live here. We're going live on LinkedIn. So all set. Happy to have everyone here. I hope people are kind of coming in. I think maybe we kind of wait a couple more minutes until people are kind of joining as we kind of fill this group. I see that the first couple of people are joining already. A couple of people probably on LinkedIn as well. How are you doing, Eric?
I'm doing great. I've lost track of which day it is. These weeks are this is just a busy time of year. And yeah, I was like, it's Wednesday today. No, it's Thursday. I think it's a good problem.
It is a good problem.
It means we're busy.
Right,
Yeah.
right. And I mean, I feel like supermarkets are filling up Christmas sweets already, so things are going by fast. It's insane. The years pass by pretty quickly.
Considering we still have to get past Halloween, it's
That is right.
It's just one marketing event leading into another. I get depressed when I see Christmas too early. Yeah, or any holidays that are meeting the retail demand as opposed to the spirit of the holiday. But what are we going to do? This is it.
That is very true. Yeah, hopefully we're gonna get over it pretty quickly and just enjoy the nature of it. But I think we can start already. I think, of course, this is going to be recorded anyway, so people can kind of take a look afterwards. I think welcome everybody to the session. We have one important agenda topic, or at least topic on the agenda today, which is selling to the C-suite, which looking at the conversations that we have had, and I'm sure, Eric, yours as well, it's one of the kind of big themes, especially this year. How do you master the executive conversation? How do you address the C-suite? How do you deliver value to these specific individuals that, of course, still own the budget and still can unlock budget these days? And you are a kind of fantastic expert and person on the topic, essentially doing this for 20 years, talking about how do you actually master the conversation, especially if you talk to CFOs, CROs, CEOs of mid-market enterprise organizations, and how do you go about it? And I'm very delighted to kind of introduce you and basically have the chance to talk about that topic specifically with somebody that has so much experience in the next kind of roughly 45 minutes. So thanks, Eric, for joining and kind of giving us a chance to learn a bit from your expertise and experience over the last, of course, over actually a couple of decades, essentially, right? So great to have you on board.
It's great to be asked. This topic, I mean, obviously, it's near and dear to what I do every day. And there's a dread fascination with this, mainly in the B2B sales world, because we all know we're supposed to be good at this. But the level of education we've had on how to actually execute it has been the missing link. And I've taken this up almost as a mission more so than anything else. So yeah, I'm looking forward to talking about this.
Awesome. Yeah, maybe you can give people a quick understanding of what you have been doing the last few years and what your focus is. Of course, I did introduce you in the description of this kind of webinar and also on LinkedIn. But I think it would be great maybe if you can kind of pick people where they are, and I'm happy to introduce myself as well. But maybe feel free to kind of go ahead before we jump into the topic.
Yeah, sure. So, I'm a career software and technology salesperson. That's how I got started. That's, the world I know. I did what most people with economics degrees do undergraduate. If you want to make a living, I'm in the Boston area, very rich tech environment. When I realized how much money you can make without a really high bar of entry, I jumped right in. So, learned the same way everybody else did, right? Got all the same sales training everybody else did, and was still expected to, take a lot of money from these companies for the products and assets I was selling, but never really knew how to have a conversation properly about money in a B2B sense, never really knew how to engage a C-level executive in a way that they'd say, we need to engage, not you need to talk to my IT people. So for the last 14 years of teaching it, it's funny. Whenever I deal with my clients, I say, if you came here for sales training, you're in the wrong place. We don't need more sales training. The cat's out of the bag with that. We need business training. And, we've been taught S to B, sales to business. We really haven't been taught in an organic way, business to business. So yeah, I focus on all the stuff that we weren't taught that we should know, crazy concepts like what are value drivers? Why do they matter? How is an executive measured and paid? How is shareholder value created, and all that? So that's been the mission: is to teach sales teams this stuff, but not in a way that overwhelms and makes everybody feel they have to become a CFO to speak to one. So that's been the goal.
Right. That sounds like a very difficult, becoming a CFO to speak to one sounds quite cumbersome.
Too much. Yes, too much.
Thanks, Eric. Thanks for the introduction. So yeah, I'm Max. I'm one of the founders of Minoa. We essentially build software to help companies better understand value and communicate the ROI of their products. And of course, that's kind of a good leeway to tap into the first topic as you kind of introduce yourself. One of the things and themes that we're seeing is that a lot of the sales teams are actually struggling these days, especially in technology, where quota attainments are going down. Salespeople are seeing like large delays in sales cycles and basically an increased stakeholder group, especially when they talk to mid-market enterprise organizations. Looking at 2023 and maybe looking at 2024 as we're kind of entering the last quarter of the year, how are you looking at this year and how is it different, especially looking at the sales teams that you're working with compared to previous years?
Yeah, so everybody's feeling this. Everyone's feeling this slowdown in the velocity of the revenue we're bringing in, feeling a slowdown in actual, the accumulation or building of pipeline. There's been a sea change, and you really don't have to look any further than the macroeconomic environment, right? We enjoyed, even with some hiccups like COVID and some other issues, we've enjoyed 13 years, in mature economies of expansion. Slow, plodding GDP growth, but basically free money, right? After the global financial crisis, interest rates were artificially low to the point where capital or money was almost free. And there was no recession to worry about, through all the ups and downs and little disturbances we had. We really haven't experienced a recession in a meaningful way. And so we had 13 years of cheap money, and, you had a lot of behaviors where no one was really worried, even at the CFO and CEO level, about spend. It was growth, and there was plenty of capital around. 2023, if you remember, in December of 2022, all the prognosticators were saying there's going to be a hard landing. Hopefully, it'll be a soft landing. Western Europe, U.S. especially, it was an expectation that the party's over, and they were wrong. In a lot of ways, there was no real hard landing, but there was disruption. I mean, the UK felt it, the US felt it. But the main problem is that interest rates, right, had to rise to deal with inflation. All of a sudden, the cost of capital has gone up. The returns on that capital being employed have gone down, and everyone's been holding their breath. So 2023, especially if you've sold just within the last 13 years, your career spans that. You haven't experienced selling in a recessionary environment or during the end of a business cycle, which is really what's going on, right? We're dealing with the end of a business cycle. There's nothing wrong with that, right? Business cycles are part of that's why it's called a cycle, are part of the macro and microeconomic environment. But 2023 caught a lot of people off guard in terms of there was a lot of budget-based selling going on, harvesting of budgets and demand. Well, in 2022 and before, and in 2023, this was not a very conducive environment for budget-based selling, and almost everyone's selling skills have been based around more of a demand-centric, budget-based motion. So it's more that we never really learned how to talk about things like allocation of capital, more strategic, executive level imperatives. And so that's really what's going on. It's that 2023 created this fear, some slowdown, but a lot of margin management, right? And keeping powder dry. As we look to 2024, right, there's still concern in the US that we're in for a hard landing. We're not supposedly out of the woods, but nobody knows what's going on. So you're still seeing a lot of budgetary management, very, very EBITDA margin focused and being very conservative. And so I don't see this environment changing in 2024. If you're a budget-based seller, you're still going to struggle with pipeline, with revenue velocity, and with actually, securing revenue if it's sourcing from budgets.
Well summarized. Thanks for sharing and kind of giving us an overview of kind of where this is going, but also where it's coming from and how it's going to impact specific sellers. So it feels like it's essentially, as kind of the markets were changing and we're kind of moving into, as you mentioned, right, a potential hard landing here. Like, of course, everybody's kind of taking half a step back to think about how do we kind of navigate this scenario and how do we essentially make the best out of it, whether you are corporate or whether you are a SaaS company, a startup, right? Everybody's kind of thinking about similar questions, but of course, different people are measured by different KPIs and different shareholders. How do you, like, where do you see these specific the gaps, right? Because you mentioned that there are certain people who might have been selling for like 10, 12, 13 years. So they maybe didn't experience the 2008, 2009 crisis, where when I talk to sales leaders, they always say it feels kind of similar. There are some overlaps and similarities. There are probably some people who have not experienced that and they kind of tap into this world now and they might be overwhelmed or surprised by the complexity of doing sales. It's not as easy as anymore as a few years ago. Where do you see the particular gaps of specific sellers in this environment compared to maybe what has happened a few years ago and even like 2 years ago, if you're honest about it?
Yeah. I mean, the interesting thing is, I mean, at this point, I've trained about 20,000 people across 33 countries, and I've had the honor and luxury of being able to do that with my clients. And the trends are very, very consistent. It doesn't matter if you're in Singapore, Shanghai, Buenos Aires, New York, Waldorf, Germany, wherever, that enterprise B2B sellers have a common execution gap and knowledge gap, and that's around the fundamentals of corporate finance, the fundamentals of how to have a conversation that's tied to how your assets affect the measures against which the C-suite is gauging the operational efficiency of the business, and how the analyst and investor community is gauging, right, the viability and the attractiveness of these businesses in terms of attracting more capital. And most of us were never taught, even if we went through value selling and traditional training, we weren't taught, how is the business measured? How are the executives paid? One word I love dropping, and it drives my peers nuts, is the word fiduciary, right? How do our assets feed and help executives achieve their fiduciary obligations to their shareholders, if they're PE owned, to their stakeholders or to their owners, even if you're a private company, to ensure that you're generating as much free cash flow as possible to keep growing the business. And the common thread with all salespeople is that we were not taught how to talk about money. We were not taught how to sell forward-looking cash flows and how to discount them accordingly. We weren't taught simple concepts like IRR, internal rate of return, and that the CFO is going to evaluate any investment, especially strategic investment, based on its internal rate of return versus other assets. And so the problem is that this has always been sleeping. This problem has always been sleeping, and there's in strong economies, there's always enough demand to harvest budgets and to do enough of that. But it's amazing how much money companies are leaving on the table by being married or stuck with this demand-centric motion, and they don't have a complementary supply-centric motion. This is the net new motion where they can not, demand-centric motions are discovery-based or qualification-based. They require an active participant to say, we'll go through that with you because we're in the market. There's a big chunk of every company's total addressable market that isn't in the market this fiscal year, that if they knew the shareholder impact or the financial impact you had on a strategic level, they'd consider allocating capital that has nothing to do with budgets. So this has always been there. This has always been there. It wasn't like it was sleeping, because this, if you understand this, you've built the right neural pathways in your brain where you'll recall it. And you're just dusting something off and putting it back into operational use. This is a gap that has never been really properly addressed, or the business discussions were always outsourced to the value, management or value engineering teams as a subject matter expert. So nothing stuck to us. The irony is corporate finance is actually pretty simple. It's learning addition, subtraction, and algebra 1. If you're doing an NPV calculation, understanding cash flows and what value drivers they align to. isn't complicated. It just requires some good collaboration internally to make sure marketing, sales, enablement, everybody knows, how do we actually generate business value, and how is it measured? Are we a revenue growth play? Are we a change to working capital play, feeding free cash flow? Are we a SG&A play?
Interesting.
It's a big topic. I'll try to keep the answer shorter, but that is the reality.
No, I think it's good to give context, right? Because people are in different maturity levels as a salesperson. So I think it's good to understand to kind of how to even think about it strategically, and then kind of narrowing it down. I think one thing that, when I kind of remember conversations with different sales leaders, I often see that they say the best performing deals and the largest deals were the ones that were actually directly allocated or directly related to a strategic priority of the C-level, right? And if we see that we are part of the mid-level or a frontline management, then it could be a great opportunity. But of course, we're probably not going to get the AR out of that specific deal as we expected to have it, right? So there are kind of certain questions about it that you kind of mentioned, that unlocking budgets is still possible if you address a strategic priority. And I would love to take maybe half a step back about, we have different software companies, different companies in general that are selling to different stakeholders, right? CIOs these days a lot, especially if you think about security, CFOs, which essentially I think they are involved in 60% of purchasing decisions nowadays. And then of course you have the CEO, which has different metrics to look out for as well. Maybe you can give a short kind of summary about, and of course, this might be different for organizations, but in general, what, as a seller, what should I think about if I target a CFO versus a maybe CIO versus a CEO versus COO, right? I mean, of course, each specific role is different, but is there some general concept that I can maybe have in mind about which metrics they are actually measured by that will help me better address their concerns and their problems directly?
Yeah, that's a great question, and it's a really important one. Selling is one-to-one. Usually, right? We're trying to engage and motivate an individual, even if there's a group of people in a room. There's always that person who actually can make the decision, who we're really speaking to, even though we're dealing with other people that influence or guide or advocate. The most important thing for us to understand is salespeople, because you're right. In tech, we sell to the CIO. Why? Well, because the CIO owns the budget, right? And so there's this attachment. Well, that's where we think the money is, or that's where we've been told the money is. So now we have to constantly key in on that person. Ironically, most of the technology companies I deal with are not selling assets that are creating business value for the IT organization. They have business assets, or they have assets that are creating business value across multiple functional areas in the business, depending on what it's designed to do. And so and a lot of this is either touching business process or the people that touch a business process. So we go to the CIO because we think they have the money, but the bigger question is where in the business, going back to business, not sales to business, is when our assets are funded and operationalized, where are the cash flows that we're creating going? From which business processes and which functional areas are seeing an increase in that cash flow output, and which value drivers are being impacted? Because then the question is, who owns the KPI for the output of the process that contributes to the company's generation of revenue, of profit, of operating and free cash flow? That's how we should determine who are we speaking to, because you're going to resonate with somebody if you're saying, look, these assets are designed to increase, right, your contribution to the EBITDA margins of the company, primarily through an uplift in gross profit by optimizing or driving down cost of goods sold. Since your functional area is a critical contributor to that, and you have to manage this area operationally to optimize that to meet your fiduciary obligations, right? This is why we're reaching out to you, and this is our ask, right? Is will assets that are performing this way be something that you would consider funding on their financial merits? So even if we're talking to a CIO, we're talking to a CIO because they own the technology. But if the technology itself is, for example, driving incremental revenue or profitable revenue, let's say it's MarTech, right? The CIO will be involved usually, or should be involved, about how that asset fits into the overall technical strategy of the company, but they're not making a decision right, on the business value of that. It's not for them to do so. It's for them, if maybe it'd be a proxy, to bring it to the CFO to say, of all the things you're funding through marketing, which requires a lot of money to operate, you know, are these assets on their financial contribution to revenue and profitability something that you'd consider funding based upon their financial merits? So we tend to talk to the people we can get access to, not the people that we should be engaging, who would say, I own that KPI. Right? The CIO doesn't own the incremental revenue expected through the online channel, as an example, if that's what you're affecting.
Right.
But it may come out of their budget, right? So I don't want to get into that argument of your insufficient budget to do the things you already need to do and all the reasons why you can't fund this. I want to sell the cash flows that makes the CFO and the CMO say, we'll find the money if you can do that. So the KPIs should drive who we're engaging and why, and it should be tied to how the cash flow and the value driver change maps to that person's charter. Now you're having a relevant conversation.
Yeah, and it kind of goes beyond just, the typical qualification frameworks, MEDDIC and others that, of course, suggest to find that specific economic buyer, right? It's more about you might need to find the economic buyer, but you also might to bring in other stakeholders that feel more responsible for the KPI that you're driving. And I think there's a great question actually from Bob, and I'm trying to make it interactive as much as possible. So maybe we can bring in questions here. Thanks, Bob, for kind of bringing this in. He's asking, how about selling things like cyber, which is essentially an insurance policy that generates no cash flow? How would you kind of go about these specific maybe verticals where maybe it's not directly, or maybe supposedly not directly impacting
it's a good question.
Cash flow metrics?
Yeah, so it's a good question, because I worked with, back in the day, Symantec and VeriSign, and companies were saying, look, we're preventing DDoS attacks. We're not generating cash flow. We're actually protecting cash flow. So it's a great question. I assume that's where we're going with this, yeah?
Yes, absolutely, yes. So it still all boils down to money, right? If a company is going to invest in security software or things that are more insurance policies versus directly correlated to generating cash flows, you're doing one of two things for a business. You're actually actively generating cash flow, or in this case, you're protecting cash flows. As an example, I'll give an example with VeriSign. They were selling to the CISO. And they said, well, the CISO owns security, and therefore that's who cares about this, and therefore that's what's the KPI. And they're the ones who are going to they don't make the decision, but they're very influential to the CFO about potential exposure. And as you might expect, nobody has enough insurance, or very few people have enough insurance. We don't like to think about our death or our injury or whatever. We just assume that's not going to happen, and we put it off. And we always say, well, what if it doesn't happen? And I've paid all this money, I got no return because I never used it. That's not the question. What I asked the folks at VeriSign is, I said, okay, look, who are your best customers right now? Who's giving you the most money? Who sees the value? And they said, well, anybody who is driving a lot of revenue through the online channel, that's big for us. And they were telling me a story about protect the innocent, but a big retailer who drove a lot of revenue through their online channel, and they became a big customer because there was a DDoS attack on that online channel that took the site down for a day. And I said, okay, how much revenue is coming through that site on a daily basis? And they gave me this multi-million-dollar number. And I said, okay, so the CISO is not who you're selling to. You're selling to the person who owns the revenue through that online channel. Who's that? And they said, well, that's the senior VP of online marketing, or it's the CMO. Okay, so how much revenue are they willing to forego from that online channel based on their KPIs? How much downtime are they willing to tolerate before they have to protect against that or make sure it doesn't happen? And they said, well, $1's too much. Okay, so why are you talking to the CISO? You should be talking to the person who is now yelling at the people saying, you just disrupted revenue that we cannot forego. We can, our forecasts aren't based upon losing revenue through this. We just expected this was going to work. So it's critical, and this is where fiduciary comes in.
that CMO, that CFO, that CEO has a fiduciary obligation to their shareholders to ensure that whatever they're spending their shareholders' money on or investors' money on is in the best interests of those people. They are constantly looking to optimize the returns. A big part of that is risk management, making sure that we're not disrupting the revenue streams or the profitability because we didn't have the right operational measures or assets in place to make sure that didn't happen. So it's still very much a business discussion.
Mhm.
And a big part of a fiduciary obligation is not only return on invested capital, it's risk management that doesn't disrupt those
Mhm.
returns and being responsible in all ways. And whenever I'm dealing with loss avoidance as opposed to generation of cash flow, the question always should be to the people you're in front of, how much money can you lose before it becomes a problem for your shareholders or for the business? It's not meant to be a loaded question, but I guess it is a little bit because their first answer is going to be none, right? Well, but there's going to be cost structures involved in getting security in place. So now they got to think about how do we justify the costs relative to, right, the potential disruption to cash flows, right? So it's either you're generating cash flows or you're protecting them. Both are of keen interest to the
Mhm.
people who own the KPIs for those particular cash flows. Does
Yeah,
that
and it
help?
kind of absolutely. I think, of course, Bob, maybe give a thumbs up or a certain sign if we can answer your question or if there's like a follow up to that. But I feel like the coming like full circle, what you said earlier, right? Like thinking about beyond the economic buyer, who are the relevant stakeholders that you might need to address, and then as a seller or as a sales leader coaching your sellers, you have to have some sort of guidance and plans of how to get to these specific stakeholders. And I feel like looking at most organizations we talk to, they know which other people are impacted by that specific problem that you're solving, right? It's of course there's the economic buyer, then but there's like usually stakeholder maps being created by product marketing teams and product teams that usually can give you some guidance on who else you might need to bring in order to facilitate these discussions around which assets, as you say, are being impacted, right? So I feel or which KPIs are being impacted. Maybe very practically speaking, there, like when you look at kind of the when you look at the great kind of companies you work with, how do they kind of make that switch from maybe they are earlier in their maturity curve around truly understanding how to like sell to these executives to kind of making a first kind of leap into getting better at it and kind of coaching the reps? Like what is like a very tactical way of kind of making the 0 to 1 move there?
Yeah, it's a great question because for most of us, salespeople aren't. I would never say salespeople are bad at this because how are you bad at something that you never learned or never was required to learn as part of your operating motion?
And they're interested in business, right? I mean, that's clear. That's why they do it.
Well, I was going to say the that's one side of the coin is to say
Right.
you're absolved necessarily from something that you were not taught properly. However, most of sales is self-taught. If you really boil it down, we learn by doing, we learn by executing, and so the position I'm in is always let's start assuming that you know nothing about engaging a CFO in a peer level narrative where you're guiding their thinking, because that's a big request. It's a big ask, because that's what we need to be doing, right? If a CFO is going to give us time, it's because they're viewing us as bringing them a business idea that's worth listening to, not talking about capabilities and technology. So I would argue the best place to always start is to internally make sure everyone's in agreement with your executive team, marketing, sales, enablement, everyone is in agreement on the value drivers that the assets that you're bringing to market impact. So, if not in an abstract way, it's and be exhaustive. If you have assets that are inclined towards cost savings, right? Well, cost savings is way too general for an executive. There's a lot of ways we can save costs. Are you saving costs around our gross profitability? Are you saving costs on our cost of goods sold, which is a gross profit discussion? Are you reducing our SG&A costs, which are tied more to the operational aspects of our business, which have a direct impact on EBITDA and EBIT performance, operating profit? We need to be more specific. And if you always work backwards from the value drivers against which that business is being assessed and measured, it starts to put this into much clearer view as to what what value are we bringing to an executive that they're measuring all the time?
Mhm.
And so, and they're not esoteric concepts, right? SG&A as a percentage of revenue is not a mysterious concept. EBITDA and EBITDA margin and why it's important. But if you're not clear on that, or if you're saying, look, we're primarily affecting a company's working capital, so we should be having discussions around free cash flow generation, everyone should be on the same page at the very least of when our assets are funded and operationalized, these are the value drivers that change, or to the point about cyber, these are the value drivers that we protect.
Mhm.
But if you don't get that concept, you're not in a position to talk to an executive in a way that they want to be spoken to. Like,
Mhm.
what are we talking about here? Are you going to increase our revenue? Or are you going to going to give me a better EBITDA margin story to bring to the analysts on my next quarterly analyst briefing? What are we doing here? So start there.
How do you when is a good timing to approach your existing champion to lead into the conversation with potentially the economic buyer, but then maybe also with the one that's actually on the C-level responsible for the KPIs that you will be driving, right? Looking at kind of value drivers and everything that you've talked about, what are the capabilities that you can actually contribute with your product, but how does that relate to these potentially several stakeholders that you need to involve there? One being the economic buyer, which not necessarily might be the person that's going to be feeling the KPI that you will want to be driving. Like, when is a good timing to start driving and leading your champion into the conversation with these more senior stakeholders, C-level execs that will be looking into these KPIs?
Before you consider that person a champion, let me put
That's a
some
hot
meat.
take.
Let
That's
me
a
put
hot
some
take.
let me put some meat on that bone. We often call people champions who are nothing more than coaches or fans or who are advocates. And a true champion, is that what status is higher than champion? This is somebody who is literally going to sell when you're not there. This is the person who's going to make sure that as much as they can that your assets are purchased over alternatives. So the first thing I think is critical is that I don't think we can consider anyone a champion unless they understand how to have the financial conversation, or what they understand how and why what we're selling funded. And
Hmm.
if they are not in a position or don't have the appetite or desire, they're not a champion. And I think we over rotate too much on that. The financial conversation, this is going to sound a bit backwards, but the financial conversation should be the first conversation we have, irrespective of how the conversation starts. So in a demand-centric world, we love leads, right? And love people calling us. It beats prospecting. If someone asks for a demo, we should be having the financial conversation. If someone asks for pricing, we definitely should be having the financial conversation. If someone wants to just learn more about our product, service, or whatever we're selling, we should be having the financial conversation. So what I mean by that is, if anyone is engaging us, as soon as we say we'll engage with you as a vendor, we're burning our own SG&A. We're burning our time is money. The people who support us as time is money. If we don't have an agreement on the business reasons for engaging, even in a demo, then we're burning SG&A, and we're setting the expectation with them that we don't need a business reason to engage with you. And so this is hard, but it's necessary. So if somebody says, hey, we'd love to see your product, we'd love to see a demo, the answer normally is, that's great. Let's get our calendars out. We'd love to show it to you, as opposed to, hang on a second, the conversion rate on a first touch asking to see the product is probably 6%. Maybe it's 12%. Maybe it's 33%. Usually not that high. That's still an unacceptably high loss rate in terms of first touch to revenue. The first thing we have to do is have that directional conversation around the financial and the business viability of funding and operationalizing these assets for that business. How do you do that with somebody who is a manager level or below, who says, I would just love to see your stuff? That's the hard part. But if you understand, look, these assets aren't for everyone. They can't be justified everywhere. on their business merits because there's many variables, but we need to talk about what value drivers that this business is seeking to change or impact with these assets or even alternatives to justify both of us committing scarce time and money to engaging. And now it goes beyond that, right? You have to literally be able to drop something and say, look, the internal rate of return on these assets typically in your space is around 117% on average. But with that said, what IRR does your CFO need to see these assets meet or exceed in order to consider funding them versus alternative assets? That's not easy to do. You got to know your IRR. You got to have a sense of how to have this conversation. I'm not telling you no. I'm telling you maybe. That feels awkward. I'm speaking way above this person's pay grade. It's immediately going to get uncomfortable. But we're trying to quickly surface, is this person serious about these assets for their business and what it's going to take to get them funded? Or am I being used to show them a product and hope that they're going to buy it? We know how hope converts. Hope converts at a terrible conversion rate.
And I mean, you often talk about reading public reports, right? That's often something that we both have talked about, like actually understanding, especially if you're selling to public companies, like trying to better understand how are they doing against their competitors. And that might be a way to enter the conversation as well and kind of look at kind of just public information out there as a way to facilitate the first conversation. And I would love to kind of dive deeper into that specific topic of which maybe like public data you could utilize as a salesperson. But maybe taking like a mini step back here, I feel like oftentimes when I talk to AE specifically, they might not necessarily have a champion or a person on the other side that actually feels the urge to kind of think about the top level objectives, right? So are you going to stop there and like think about just multi-threading immediately into somebody that might be more confident about talking to these numbers, or are you still kind of trying to maneuver your way through the organization? Like what's your thought process here?
There's so much legacy motion that we have around this, and we feel that we've got to engage these people maybe as a means to an end, or you're on my path. A lot of this is conflicting with what the orthodoxy has taught us. Selling with a strong business mindset isn't just considering all the business aspects that the buy side has to consider. It's also the business aspects that the sell side has to consider. We should have a profit and loss mindset because we do not have unlimited time as sellers. Every deal we work that's not going to close is stealing from time for a deal that might. And we should be entering into every engagement with a requirement that both sides are respecting the fiduciary obligations that we have to our shareholders. If you're a startup, it's to your investors, and make it clear that from the first touch, this is a business conversation. This isn't a sales conversation, because they don't care about the sales conversation. And so, knowing to the first part of what you're talking about there, Max, knowing how a company's performing against their value drivers, looking at their most recent quarterly, if they're public, looking at the most recent quarterly reporting and seeing how they're performing on a trailing 12-month basis, and understanding how they're reporting, especially against the value drivers you affect, should be always the first step. Looking at their forward-looking expected performance and how they're indexing towards that, and what your contribution is to that, is something we all should be very familiar with. We should be making it clear, until, whether you're a DBA or you're the CFO and CEO, we should be making clear that for us to invest, for you to invest in any of these cycles, we both have to understand what is the business outcome, what is the financial objective, what is the financial and business reason for you to even consider funding and operationalizing these assets. If neither one of us knows that, then we have no idea whether we can even provide you with the right asset. We don't know if we can prove that. If we can't, we have to agree that you're the first one in this particular situation. Well, we don't have the precedent of a peer that's done this. This is especially when you get into your startup and you don't have a big customer base to leverage. But the part that sounds weird to a lot of people is, why would I have a business conversation with a lower level tech person or somebody who does not concern themselves with funding? It's because that person's going to burn your SG&A, your time, and that we can't do that. In other words, we can't give you 5 demos. We cannot, take all this time unless we both understand the financial outcome that needs to be achieved. We can't say yes or no to that request until we understand, is there a there? Is there a viable financial reason for both of our organizations to commit to a business relationship? And so it's a mindset shift that even if I can't get to the C level, I have to have discussions that tie to how the C level is going to make their funding decisions with anybody who's engaging me, mainly to gauge, go back to the champion thing. If you're really a champion, you should be saying, you're right, we need to have this discussion because we don't want to waste time on something that can't be funded. And in this environment where there's so much uncertainty and so much is changing quarter over quarter, we don't even know what the CFO's requirement's going to be next quarter when we believe the decision's going to be made or the technical process will be done and it's time to present a business case.
And I think there's a great kind of follow-up question to that from Bob. Is it a necessity for a seller to have a conversation with the C-suite, or is talking to them through the champion enough, right? Because as you say, the C-suite is going to be on high pressure as well these days.
Sure.
Everybody kind of looks at them. So actually getting to 30, 45 minutes of their time is going to be hard. Is it always necessary to talk to them directly, or is there a different pathway sometimes? Is that possible?
Yeah, so the short answer is no, it's not always necessary to talk to them to get it done. But there's always a big but here. That's a function, right? It's a function of the person who's going to be your proxy, their ability to communicate the business case in a way that would effectively be the way you would do it yourself. And we don't know that until we engage these people. Some people have a much higher degree of financial fluency and literacy where they can do it. And I've seen it before. I've had many examples of where, salespeople and value teams have given something to a CIO or a CMO or another, head of supply chain who had the business skills, knew what they were seeing when they looked at the business case, was collaborating, right? Every business case that is viable has to be arrived at collaboratively. You can't have, well, here are our pro formas for your industry. Good luck, and that should apply to you. We should always be gauging, will you collaborate with us on this business case? We need your inputs to make this it's pro forma in either case. But if we're doing a 5-year discounted cash flow analysis, then we have to have your critical inputs to make sure that whatever business case we're putting together is relevant to your operations. You can do all of that with someone below the C level if they have the competency to do so. And then often they can represent it in such a way where you may not have to be there. The most critical thing to this question, and this is what I see everywhere, you have to prepare, you have to have the narrative, you have to have the assets, you have to have the numbers as if you're engaging with the CFO, because they're the ones with the criteria that has to be met. Whether or not that's delivered through a proxy, as long as we are always saying this is the conversation we would have with the CFO, and we're equipping that person with the fundamentals to do so, because then they make a decision. Then they say, you know what, you do this better than I do. Let's make the CFO meeting happen. Or they say, I got it. CFO doesn't want to meet with vendors. And then it's like, okay, let's make sure you and I are on the same page here. Let's stress test it. We'll play the CFO and you present to me, right? There's the people that have a willingness to do that often can get the deal over the line, right? They know how to ask for money, right? They're presenting their budgets to the CFO all the time. So yeah, you need to know how to do it. You don't necessarily have to do it yourself if you've got a proxy that is showing the skills to do so.
Yeah, your business case will be shared around, right? I think that's pretty clear from what we're seeing in the market as well. It's not going to be sitting on that one person's table and it's never going to go across the organization. As soon as something gets more relevant and people consider actual budget, then it will pass certain people, and you might actually even know which people it has passed and how it should influence the decision at the end, right? So you want to be in control. as a seller to kind of influence that process and at least see who's engaging and who's involved and prepare the business case for the right conversation and the right people. As we're kind of wrapping up, because I think we are kind of 30-second over time. Looking forward, right? I think we talked a lot about quota attainments are down and like sellers are struggling. It's a tough market. What are you optimistic about? What is something that kind of you're excited about going forward? Yeah, what's your passion?
Yeah, so it's a terrible year, and next year may be just as terrible, to be dependent on budget to meet our targets. But we're in a prime environment for capital allocation based selling, right? I saw in the Wall Street Journal in the spring, they were interviewing the typical cohort of senior executives and CEOs and asking them what they were going to do this fiscal year in terms of investment. And something like over 60% said they were actively going to be focused on strategic investment and intermediate to long-term investment. Most of my clients, most companies we deal with have assets that are multi-year assets that affect a business for more than just a single fiscal year, which means you have assets that can and should be considered for intermediate to longer term value. And executives in the last decade have put a lot more money into stock buybacks and into M&A with cheap capital, to where they haven't really been investing the way they should with technology, especially for intermediate to longer term business value. So I'm very optimistic, that if you know how to do it properly and your assets do align with strategic value, if you get to the C-suite, you're going to be much more likely to have a conversation that they're going to be open to hearing. So it's not all gloom and doom, right? Budgetary selling is going to be limited. Capital allocation selling is definitely going to be something that, when done properly, is going to resonate with the right level.
And it's good, right? I mean, there can. Thanks for sharing that. There's a way to unlearn and learn new things to get better at what you do, and kind of use the time as a way to basically get more deals done by maybe utilizing a new skill, right, and getting better at it. So thanks, Eric, for kind of sharing all your thoughts and experiences. I think it's been incredibly helpful and kind of delightful to talk about these topics, as it's so relevant these days. Just how can people get in touch? Like, what's the best way to kind of get in touch with you and basically learn more?
Easiest way, go to LinkedIn, just like everybody else. Yeah, Eric Shaver on LinkedIn, and happy to just have conversations that need to be had. But that'd be great.
Awesome. Thanks, Eric. Have a good one.
Thanks, Max. Pleasure.